The biggest problem is going to be capital availability and the shortage of capital. From this point on, I think it's survivability rather than growth. You have to grab the bull by the horns. Once problems are identified in any one sector, the banks often relocate lending. They will also tighten up LTV, loan to value, debt service requirements, more equity, stronger covenants, and higher spreads. Spread is from the GOCAN, the spread they make after on mortgages. The producers usually are a little bit disconnected from the lender's line of thinking and what's important to the lender. Producer knows his stuff and he takes a lot of things for granted because he works every day with that. But you have to grab the bull by the horns and have an accountant or somebody, because accountant will think very similar to the way that banker thinks in identifying the red flags. And then you go through it all. I've done it lots of times. I do it on a regular basis, where I go identify my red flags, and then try to address them in numbers, not in I can maybe do this or maybe do that. Just talk and do it in numbers. So you're giving your lender ammunition to go and promote and fight on your behalf. No, you don't have to foreclose. No, we don't have to do this. We can give it more time.
Yeah, no, I got you there. Okay, so start with your accountant, go through your red flags, go through your financials. Then point number 2, and I know this seems really simple, but go talk to your banker in their language. Give them the ammunition they need on the key metrics that they're looking at to strengthen your case.
Yeah, well, the whole thing is to be proactive and give your banker some ammunition. He has to explain it to his higher ups, and depends how big the loan is. It goes next level, and then ultimately ends up in Toronto if it's really big.
Right. Yeah, there's a hierarchy there. And then number 3, run your business by the same metrics that the banks use. So manage it on balance sheet strength, liquidity, coverage, rate sensitivity, all that good stuff. Update collateral value, structure debt conservatively, spread lender exposure.
From this point on, I think it's survivability rather than growth. And cover all the inefficiencies or any inefficiency that you see. Example, like even simple things, like let's say you got 2/3, 10 miles away from, or 5 miles away from your main operation. Couldn't your time be better spent if you had those quarters much closer, or even maybe with them, so you don't have that inefficiency? And then look at your balance sheet strength, your liquidity, your coverage ratio. Banks always have a coverage ratio they like to see. Whatever it is for an individual is according to his credit rating and everything else. Rate sensitivity, if you had to renew a mortgage, where would it be? What I see, maybe as a side note, I don't think we covered it. I see interest rates going down most likely in the very near future. And no matter what Powell says, the Fed chair, US,
he's done like dinner. Yeah,
that they're not going to lower this and that. I think the unemployment numbers are going to go through the roof in the US. increase a lot anyway. And that'll force Powell's hand to lower interest rates. And with all those problems in commercial real estate, shadow banking, derivatives, and everything else, he's already at the window contributing billions. In other words, QE, quantitative easing. But they don't call it that, they call it something else, but the result's the same.
Yeah.
So I think that'll force his hand and lower interest rates. But the problem isn't necessarily going to be the lower interest rates. Problem is going to be capital availability. I was asked that same question by Ted Cockwell in a breakfast 3 years ago. Like where at that time, where the interest rate's going to go. At that time, I addressed the issue of today, where I said the problem isn't going to be the interest rate per se. Yes, it does matter, half or a point or whatever. But the biggest problem is going to be capital availability and the shortage of capital.